let's say you bought a building 3 years ago and you didn't do cost segregation. Today, you can still go back without amending the return. That's the key here. You don't have to amend your return, and you can go back and claim any deductions that you missed on your current tax return.
Welcome back to the Massive Passive Cash Flow Podcast. I'm Gary Wilson, your host. I'm so glad to have you back listening to the show or watching. If that's what you're doing, that's great. You can watch it on YouTube and Facebook and LinkedIn, a number of platforms. We appreciate you being here listening. We have a great guest today, Gian Pazzia, who is going to talk about cost segregation, a subject we haven't had for quite a while, and something you definitely want to use, guys. If you are an investor and you have, really even a duplex, you can use this to your advantage, strategic advantage. It'll help you accelerate depreciation of certain assets and give you greater cash flow. And there's more strategies. I mean, I know people that buy large buildings just for the purpose of cost segregation for a few years, and then you sell the property. So I don't know how much time we'll have to get into that deep of it, but let's go ahead and introduce Gian. Let him get started. So Gian, thanks for joining us. I really appreciate it. I love what you're doing. Excellent subject, and welcome aboard.
Thank you, Gary. I'm really excited to be here and to be talking to your guests. I just want to spread the word.
You got it, man. So let's go ahead and start in the beginning. Most of us did start off in this business or start off in life saying, "Hey, I'm going to be involved in real estate." We were, typically doing something else. Like I was in IT, for example. So what were you doing prior to this? What actually got you into this business sector?
Yeah, good question. So I really kind of fell into it. I went to school to be an engineer. That's structural engineer. That's my background. And when I was getting close to graduating, I kind of just realized I don't want to be stuck behind a computer designing structural beams and all that. And I ended up finding a job with a big accounting company called Arthur Andersen. They were one of the big five back in 25 years ago, and they were looking for engineers to help their clients, their big Fortune 500 casinos, and basically do these cost segregation studies to write off their buildings faster. That's how I fell into it. It's been over 25 years for me. We started a company that focused on this, and along the way I started buying my own real estate. So now I have almost 40 units, over 7 properties, and so I'm playing the game that I've been helping my clients avoid paying taxes on all these years. So starting to implement these strategies for my own portfolio.
Yeah. Well, I love the philosophy of multiple streams of income, particularly if they're related. So what you're doing, you're investing, but you're also using something that you're using for your own investments to serve others. You've got income producing assets, and you've also got a business producing revenue. But that's just classic. You're Robert Kiyosaki would love you because you're following the cash flow model perfectly. So let's start to unwrap this a little bit. For those who are listening and really don't even they've heard the term, but are really not quite sure what it is. Can you break down cost segregation? What actually it is from the beginning. We'll go from there.
Yeah. So cost segregation is a way for real estate investors to pay less income tax by speeding up how fast they're going to write off parts of their building. So normally the tax rules say that you have to write off your building very slowly. So for residential rental properties, the tax code says 27 and a half years. And then for some commercial properties, it's as long as 39 years. But not everything in the building lasts that long. And so the tax rules are a little confusing, but things like vinyl flooring or carpeting, cabinetry, the appliances that you acquire with the building, asphalt driveways, all these things don't last as long as the building. And so those are the kinds of things that can be written off quicker. And so a cost segregation study breaks the property into all those different pieces. And a lot of the things, like the ones I just described, can be written off in year one. And so you're getting this bigger tax deduction right away, which
Mhm.
means you're saving your taxes today, and it really becomes a time value of money play. That's what this is all
Yeah.
about. And so sophisticated real estate investors and developers have been doing this for 50 plus years. And really it hasn't trickled down to the smaller investors until the last 10 to 15 years, as
Mhm.
more companies like mine have popped up. But just to put some numbers to this,
Okay.
to put it into perspective. So imagine you buy a rental home. Let's say you pay $270,000 for it.
Okay.
Let's assume there's no land value to that, right? So you get to depreciate $270,000. So normally, without cost seg, you're going to be able to get a $10,000 deduction for each year for 27 years.
Okay.
Okay, but by doing one of these cost segregation studies, you could get as much as 25% of that purchase price or that value of the building that could be
Mhm.
written off in year one. So now we're talking $54,000 of deductions instead of that
Wow.
$10,000 of deduction. So, as the purchase price of these buildings get bigger, those deductions get bigger. So you're looking at almost 5 times more in deductions by doing this in year one.
Yeah. That's amazing. So, and really, it's just an example. You mentioned, the vinyl, for example, cabinetry. So what, you know, and I know this is far more complicated than a half hour podcast, but let's give an example of like cabinetry or appliances, like what the average um, depreciation schedule is for that versus the 27 and a half years for the property. I mean, that the IRS allows us.
Yeah. So things like the cabinets in the kitchen or the appliances should be depreciated over 5 years for
Okay.
residential rental properties. And so, but they're included in the purchase price, right? And
Right.
you need somebody to break up the values for those things. But it goes
Right.
beyond that. Like when you think about it, you have dishwashers, washer dryers, um,
Mhm.
even the piping, the water piping, and the electrical wiring that's supporting those, that's inside the walls, actually
Okay.
takes on the same uh, tax life as the
Okay.
appliances themselves. So when we do these studies, we're quantifying the value, even the wiring, all the way to the panel boards.
Yeah. So if the wiring is, say the wiring is estimated to be worth $10,000, instead of depreciating that over 27 and a half years, getting, whatever, $275 a year, you're really doing it in a 5 year period, which is increasing by a greater than a factor of five. So you're looking at, you know, you know, probably 1,300 a year. Well,
Yeah,
actually, well, sorry, let me go back here. Yeah, if you kind of correct me, because I think you said year
yeah.
one you could take that.
Right.
Yeah.
Yeah. So
Ah,
there's this rule. It's called bonus depreciation, right? Which
okay.
normally you get to write these things off over 5 years, like you were saying,
Hmm.
right? So $10,000 for the appliances, you get 2,000 a year for 5 years, right?
Okay.
There's this rule that's been that got put into place when Trump's first term came into play, where he said, you know what, I'm going to let you guys take 100% bonus depreciation on any equipment, right? And so
Hmm.
he said, okay, instead of 5 years, you get to take it all and write it off in 1 year, okay? And so
Nice.
since 2017, that's been in place, but it's
Hmm.
started to phase down. And it was
Hmm.
supposed to go away completely in about 2 years. This year, the bonus rate is 40%. However, in President Trump's address to the nation a month ago,
Hmm.
he specifically called out that he wants to bring 100% bonus depreciation back. So it's highly likely that that one's coming back.
Yeah. Yeah. It's just what's amazing is obviously it's not a political show here, but everybody that's an investor, I'm sure, was thinking this is probably going to be good. We've got an investor in the White House, so
Yeah.
understands this. There's been a lot of good legislation over the years, no doubt about it. I mean, there's things that I wish were still there, but actually, maybe not. In the 80s, I would think it was the Tax Reform Act of 80, was it 86 or 87? I forget.
86, yeah.
80s, that's the year I started investing. I was a kid right out of college, and I just didn't know. To me, that was my normal. I thought, well, the world's just been like this. I didn't realize till later that the reason why all these professionals were selling, accountants and doctors and dentists, they were using the real estate. They had a lot more write-offs and they lost them. And I benefited by picking up some really good deals right out of
Right.
college.
Yeah.
So I didn't buy the boat and the car. I bought the house, and then the house bought the boat and the car.
That's
So,
right.
um, okay. So that helps a lot. Well, listen, how about, you mentioned equipment. Does this also include like paint sprayers and carpet cleaning machines and even trucks? Like we bought a pickup truck early on that was used strictly to go between the properties and haul stuff back and forth and even put a snowplow in the front of it in the wintertime. How about those items?
Yeah, all of those. Anything that's not affixed to a building that you're using for your business, that's considered equipment. You get to write it off generally over 5 years in this
Yep.
business. But that stuff's easy to quantify and for your tax preparer to identify and handle those
Mhm.
correctly. With cost segregation studies, you're typically buying a building all for one price, and
Mhm.
that's where you need to get a third party oftentimes, like our firm,
Right.
to come in there. Your tax preparer wants to see a third party report before they can
Right.
put that on the tax return. And by the way, the IRS wants to see a third party report as well.
Yeah. Yep. So really, what's different then is if I buy a building, I could use this to determine what I can segregate that year, in the next year. But if 3 years later I buy a truck, that would be something my tax guy would normally take care of if it, bought a truck separately.
That's right.
But yeah, okay, good. Now, are there other cost segregation um, strategies or methods that people we can take advantage of, and how does this differ from those? I mean, I'm not sure how many there would be. Um, there's what we're talking about here, and then of course you buy something like a paint sprayer or a truck later on. But are there other strategies too? That
Well, yeah, there's all types of tax planning strategies around cost segregation.
Mhm.
So, you know, one thing that I think a lot of people, probably listeners to your show, understand that in order to qualify as a real estate professional, there's this requirement to have 750 hours to be considered a real estate professional for tax purposes. Once you reach that status, you get all types of benefits. You get to start netting all your income together. So, yeah, if you have a bunch of properties and you're taking losses on one and not on the other, um, you can start using cost seg studies to offset gains, and you can kind of play this game where you're really almost never paying tax if you do it right. So
Mhm.
one of the strategies is, so it's funny you mentioned back in 1986 when you got in the game, all these doctors and lawyers were selling, and the
Mhm.
reason they were selling is they changed the rules big time.
Okay.
Before 1986, any doctor who was making $1 million or a lawyer from their practice,
Mhm.
they could go out and buy real estate, accelerate the depreciation, and use those deductions against their ordinary income. Okay,
Mhm.
it was like too good to be true, right? All you need to do is go buy real estate, and I'm not going to pay tax. Well, in
Mhm.
1986, they put a stop to that, and they said, no, 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 no. Going
Mhm.
forward, we're going to consider real estate a passive activity, and you're
Mhm.
not allowed to use the deductions from your passive activity against your, call it, active income.
Yeah.
And so today, you can still use that strategy, and here's how. Um,
Okay.
you're a doctor or a lawyer, you're making a lot of money. If your spouse is considered a real estate professional, then and you file jointly, married file jointly, you get
Mhm.
to net those activities together. Okay,
Ah,
so now it doesn't work for everybody, but if you have the right situation, it's a beautiful tax planning strategy. So, for example, my wife, she's a finance person. She worked for CB Richard Ellis for 20 years. She's
mhm.
a CPA. She retired, and she's the one that's managing all of our properties. So she's meeting this 750-hour requirement,
Ah,
doing all the management. I have my business where, we do cost segregation studies, among other things, and we get to use these depreciation deductions from my real estate against the other income from my business. And that's a strategy that is it works for, it's totally above board, but I will say you got to make sure that the IRS looks at that closely to make sure that nobody's abusing that rule.
yeah.
But that's a good strategy.
So that's okay. So that's because I was going to ask about people who have full-time jobs, and I know the IRS uh, categorizes rental income as passive income, even though we know, as far as the Webster Dictionary definition of the word passive, owning real estate really is not passive activity. But there are people who truly are hands off, like you said, lawyers and doctors and folks like that. And this is how they can do that. Obviously, they need to make sure their tax accountant is on board with it, understands it, and make sure they're doing it correctly. Um, okay, this is good stuff here. So I understand you also have software, residential cost segregation software. Does that work for um, any type of property? Is it strictly
Yeah.
residential, any size, or tell us if you don't mind, unpack that a little bit.
Yeah. So our firm is one of the biggest cost segregation firms in the country with offices coast to coast. We've been in business for 25 years. We developed the very first online cost segregation software that investors can do this stuff themselves, and it was built for smaller residential properties. We're expanding that, but in its current form, any property that is residential 6 units or less that has a tax basis, depreciable tax basis of $1.2 million or less can go online and basically do these cost seg studies themselves, starting at $500 to do these. And that's a big discount. Like if you were to go out and hire a third party firm, they're charging as much as $5,000 to do the same thing that you can go online on our website and do.
That's awesome. So, let me ask you this: let's say I bought a property, today's April 30th, and everybody knows when we recorded this, April 30th. um, but I don't actually take advantage of this by December 31st. Can I do this next January, February, March, and do the have the report created and then do the write off for this year? Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live. Be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to GaryRealEstateWithGaryWilson.com. Click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Wow. Okay.
Yeah. So I'll kind of talk about the tax rules. So this is all about reporting this correctly on your tax return. So you can actually do it at any time. Meaning, let's say you bought a building 3 years ago and you didn't do cost segregation. Today, you can still go back without amending the return. That's the key here. No, you don't have to amend your return, and you can go back and claim any deductions that you missed on your current tax return. Okay, so it makes it very easy. But yeah, in terms of doing this, they do take time when you hire a third party, so you want to do it well before your tax return is due.
Yeah.
And if it's a bigger property, a company like ours is going to want to go visit the property, take pictures, collect a bunch of data about it so that we can support it in the report. But yeah, as far as timing, if you bought your property April 30th, you could do this study tomorrow, and in the benefit of doing it right away would be to understand how much deductions you're going to get so you can lower your quarterly estimated payments right away, right? So keep that cash, use that cash for something else. You can know what those deductions are.
Okay, good. I want to ask you if people love listening to case studies, real world examples. Do you have one that you can share? Success stories. Someone who's used the software, residential cost segregator, of course, while protecting the names and the addresses, I guess.
Yeah, I mean, we have a lot of success stories. If you can see our ratings on Google, there's extremely high ratings and people talking about using the software. But yeah, I mean, a typical property that you buy for $300,000 can generate $60,000 or $70,000 of deductions right away. And because our software was built so simple to use, and we're infusing it with AI, we literally have users and their CPAs. A lot of CPAs use this software that are doing it like on April 13th, 2 days before tax filing deadline, when the CPA finally realizes, oh crap, my client's going to have a big tax burden unless I do something. Oh, he's got some properties. Let me use this software and wipe out their income tax. So got stories like that where tax preparers tell me often, like, your client saved me a lot of face with my your software saved me from having to tell my client they owed a lot in taxes.
Wow. Well, what's next for your company, KBKG? It sounds like you're doing quite well, but any plans for the future?
Yeah, we are trying to become more tech focused, so we're going to be relaunching this software that I was telling you about. And we own the domain costsegregation.com. So that's going to be the website to go to, costsegregation.com. And it's going to be available for any type of building. Okay, so like I said, we launched it in 2016. We're going from residential to any type of building come later this year in October. And we're infusing it with AI to make it even easier for users to be able to get through this.
Wow. Yeah, we started using AI just a couple of years ago, and but now I mean, it sounds crazy, but we're using it to create marketing videos that are much better than me doing it. I mean, the avatar they're using for me is better than me. It's like, holy cow. I'm kind of thrilled because it means I don't have to work as hard, But how? So the AI, are you creating your own AI scripts, or there's probably a lot of techie people like you and I listening to this, and I'm sure they're thinking the same thing. How are they doing that? What is it? If you can, without divulging any trade secrets,
Sure. Yeah. Look, it's a matter of getting the information that we need to do the analysis correctly. And so instead of it can go out to the internet and start searching for public information for how many bedrooms, how many bathrooms. It can start looking at even real estate listings and seeing that the property listing shows that it has air conditioning and wood flooring, and it starts to collect all that stuff and start putting it into the software. And so it's going to ask the user to verify everything, of course, before
Okay.
they hit the report. But it's just, it's doing a lot of the legwork for the user.
Wow. Okay. Hey, I want to ask you, it's related, but not directly related to cost segregation. I understand you've done some work with energy tax incentives too for multifamily developers. We do have a lot of investors on the podcast, and I'm for one a multifamily investor, so I'm really interested in that. I'm sure others will be too. If you can shed some light on that, you know.
Yeah. So there's a tax credit out there for multifamily developers, or if you're repositioning a product or a multifamily or condos, and it's worth $5,000 per unit, up to 5,000 if they're considered energy efficient. And so,
Wow.
let's say you have a 25 unit building that you're putting up.
Mhm.
A lot of times you don't necessarily have to do anything too much more than what building codes require, depending on where
Mhm.
you're building. But if you meet certain criteria, um, you can get a $5,000 per unit. So for a 25 unit building, that's what is that, $125,000 of credits. So,
That's
and
pretty awesome.
yeah, and then there's some other incentives out there
Mhm.
that aren't quite as nice as that one, but they're related to energy efficiency. And so, in generally, if you're building new ground up or substantial renovations where you're taking it down to the studs and you're replacing things like windows and um, insulation and things like that, that's when these credits you really need to look at those.
Wow, but do you know when that went into place? The only reason I'm asking is I sold a very large building in 2015, and you know, I don't know if that was available back then, but in hindsight, we did some major renovations and we probably didn't even weren't aware of this.
Yeah,
Uh,
and that one actually came in play all the way back in 2008.
wow, that's the
So
year we
yeah,
bought the
it's
place.
yeah,
Yeah, so we could have done it. They had boilers in there. This was a massive building. It actually was three separate buildings, two boilers each, and these were large industrial boilers. They were running about 65% efficiency, and we replaced them all. It's about $200,000. Um, but we had 95% efficiency when we were done. When we saved a ton of money on our utility bills just doing that, you know. So, so we may have qualified at least to a degree, you know,
right,
just from incentive. So
right.
I'll have to call my partner Vince and let him know. He's
Hmm.
one of my best friends, and I've had partnerships before, Gian, but he was an accountant or is an accountant, and my background and his background was perfect.
Oh
And
yeah,
I'm going to call him tonight and let him know, hey, I think we messed up.
yeah, yeah.
We
I
missed an
wouldn't, I wouldn't,
opportunity.
I wouldn't beat yourself up over that one. A lot of
Yeah,
people didn't know about it back then.
yeah, yeah. Well, I tell you what, we've covered an awful lot, and I really appreciate you. We call it, sharing the golden nuggets. Um, and I can't help but wonder, like, with you, moving into being so you're an entrepreneur. You're 100% independent. You're not working for an employer anymore. This is your business. What can you tell people about that? Because one of the reason here's what I'm asking. I always tell people to be a successful real estate investor, you really can't just treat it like you buy stocks and bonds or shares of mutual funds. You've got to really feel, think, speak, and act like a business person, and run it like a business. You've got inventory, you've got clients that pay you every month. But any lessons in life you can share with the listeners who are thinking of investing or investing but wish they could do more or do better? And I mean, we have a lot of dentists and chiropractors, engineers, and software firms. We do have a lot of business owners out there. And I think hearing from you the success you had can really inspire them.
Yeah, I think uh, you go through a phase with businesses. From the very beginning, you're putting a lot of time and effort into it. You get kind of almost obsessed with your business, and uh, for me, 25-year-old business. We're doing pretty good right now. We have 150 employees with offices from coast to coast. And at a certain point, you just have to make sure you get in the game, right? And in the real estate game, because it is really how almost every really wealthy person kind of makes their money, or if they didn't make their money that way, they're then investing in real estate.
Right.
So yeah, I mean, it's finding that right opportunity, and I kind of feel like now's a great time, based off
Oh
of
yeah.
the climate and people with uncertainty. We had our highs in 2022, we all know, and at some point it's going to turn around, and we're probably closer to the bottom than we think.
Yeah. Yeah, I agree. I mean, it's the type of legislation I think we're going to be seeing next few years is going to be favorable for growth, business growth. And for everybody listening, even if you're an employee, you can benefit from this. You just have to make the choice that you're going to invest. Even keep your day job if you like what you're doing. I would never suggest stop what you're doing, but owning real estate is an excellent way to retain some of your wealth, have it grow passively. You get tax benefits. I mean, let's face it, you get cash flow, which is why most people start investing. You do get appreciation. They go up in property over time. I know the last recession, 15 years ago was a kind of a bummer, but you know what? Everything bounced back. And like you said, just look at the year 2021, 22, 23. I mean, massive value increases. So you get a cash flow appreciation, depreciation, which is essentially a phantom write-off, a paper write-off, right? You get equity pay down, which means if you have a mortgage, it's being paid down over time by your tenants, by the way. And at the end of the day, number five, you've got multiple exit strategies. You can refinance. You can just flat out sell. You can exchange into another property. You can exchange into a Delaware statutory trust. Um, there's a number of strategies you can use. You can even repurpose it. You can put it. I've had clients put properties into a REIT. They created a REIT, so they were the principal of the REIT. So the REIT got a fee for managing the properties that they sold. So they literally retain control of the properties through the REIT, even though they liquidated, they capped out, right? And they get a management fee for managing the very same properties they were already managing anyways. I mean, it's a brilliant strategy. But what do you see? We've got just another minute or two, but looking ahead, I love the fact that you're optimistic and positive thinking, and I am too. Nobody has a crystal ball, but I do believe that the things that we're seeing is waking people up and realizing, learning to invest and become financially independent is not a pipe dream for just a few. Anybody can do it. And when I started off, I didn't have two nickels to rub together. I was just out of college. There are strategies, guys, that you can learn to invest. There's multiple purchasing techniques you can use to invest. But so when you say sorry, go back to the original question. What's your take on the upcoming years? And we could go into a lot of dialogue there, but um, you know, just kind of what are you thinking? There's no test, by the way. Nobody's going to hold you. Hey,
Yeah.
Gian told me this. So
Yeah. Well, you mentioned legislation, and I can tell you from being in the tax space that there will be some major legislation that happens likely this year, and it's going to be very favorable for the
mhm.
economy. Like I said, this bonus depreciation thing is going to be good. But I also want to kind of step back and say, just being in the kind of work that I do for the last 25 years, I've seen my clients, and I understand that in real estate,
Mhm.
the tax rules, they're just slanted towards real estate. It's just the way it is.
Yeah,
Doesn't seem right, but it is. And so, if your listeners get one thing, just understand everything you said about all the cash flow, the depreciation, getting to write it off, um, pretty much writing off the building and then exchanging it. I mean, I have clients that
yeah,
literally don't pay taxes like ever
yeah,
until they die. And
yeah.
and so that is the power of the way the real estate rules work. And so, yeah, looking
Yeah,
forward, smart money realizes this. There's always going to
yeah,
be demand for real estate, and like you said, yeah, there's just a lot of money out there in the sidelines, and people want to put it to use. So I don't think real estate
yeah,
values are going to go down.
yeah. I agree 100%. But I've been blessed enough to travel quite a bit, and I actually used to live in Canada for several years, and I can see, the the things I like, things I don't like. But what I have seen in Canada that I see what's going to is starting to happen here in the States is, um, you know, continued valuation increases because we've got more demand on housing. We need more properties. It's just fundamental economics, supply and demand. Wherever there's a great need, somebody's gonna fill it. And let's think about any economy we've ever had in the country, at least in our country. It's true in most countries. When the economy goes down, what do we look to bring us back up again? It's real estate. The incentives, the grants, everything is lowering interest rates. It's designed to incentivize people to buy and to build. And when you build a home, guys, just remember all the different industries that are affected. You've got transportation because you have to ship all the materials to build a house. You've got, energy. You need energy to run those trucks and trains and buses and planes, right? Electricians, plumbers, painters, kitchen and cabinetry people, roofers, carpenters, concrete people. I mean, it just goes on and on and on and on and on. Lawyers, of lenders, inspectors, appraisers. So many different sectors are positively impacted whenever a piece of property is built. So never ever lose faith. I mean, I know it's tough sometimes. Believe me, I've been through 5 recessions, right? And it doesn't even faze me now. It's not that I'm callous. It's just I've been through enough to realize, hey, you know what? It's going to be opportunity time, opportunity to pick up properties, and it's going to come back around. The bus will be around again tomorrow. So I really hope this helps everybody listening here. And Gian, I want to thank you again. This is what a great way to wrap this up. Yeah, go ahead. Yeah.
Yeah, one last thing, I wanted to make an offer for your listeners here
Oh
about
yeah.
that residential cost segregator software. So
Mhm.
if you want to use it, I'm going to give listeners to this show a unique discount code for 10% off. That
Okay.
discount code is massive 2025, all caps. So massive 2025, all caps.
Okay.
And you'll go to costsegregation.com to access the software, and you'll
Okay.
get a 10% code for first-time users.
Excellent. Well, that's a nice big bonus. Everybody listen, I'm going to repeat that. Go to costsegregation.com, okay? And you're going to use the massive 2025 coupon code, and massive is all capped. And you get the software for 10% off. I mean, and by the way, $500 even without the discount, that is a bargain because I've done cost segregation. I know people have done it, and it's way more than that. I'm just going to tell you guys, you'd be crazy not to take the GN up on this offer here. Plus, I bet they could find a way to communicate with you via the website. I guess there's probably content on there they can use
Oh
and
yeah.
learning. Yeah, that is awesome. So, well, really, thanks again. Thanks again for you listeners, everybody listening. Please leave a review. This is especially for those of you who own multiple properties. This is the kind of gold that we like to deliver to you. And your review means everything to us because Gene and I, we don't make money doing this. It's just a community service. We help each other. We support each other. It all comes down to serving you. So your review is our fuel, and we appreciate it. Meantime, God bless you and all your loved ones, and we will see you on the next Massive Passive Cash Flow podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.